All right, traders, welcome to another webinar session. Hope you had a nice weekend and wishing you a happy and profitable week for this week. Today's topic has to do with volatility. Volatility is what drives the markets on a day-to-day basis. For those that have seen Friday's webinar session, Trading Like a Pro, the basics to know, we have went through a strategy on the euro dollar, which it is also applicable in all other currency pairs. What you have seen that is through that strategy, we have identified a bearish volatility on the euro dollar. After identifying the bearish volatility, we have seen that the euro dollar dropped aggressively down to 1.1170 approximately, where the prediction was at the price level of 1.1316. So you see, if you apply your strategy or the strategy which we have shown on Friday's webinar the right way, you increase the chances and the probabilities to make the right prediction. But let's see in today's session the importance of volatility in the forex market. As you all know until now, ArgusFX is your host for all webinars. ArgusFX is an STP ECN broker which benefits from clients' trading volume through commissions, and this is fair enough, therefore generating a win-win situation with the client. Below you can see also some benefits which you can acquire as a trader in ArgusFX: protection, regulation, no charge on deposits and withdrawals, instant funding and withdrawal, support, expertise, coaching, updates, and most of all, security of funds. So the conclusion is that when you trade with an STP ECN broker, then you've made the first step to fairness. So let's move on to the main topics that we are going to discuss today. Today's webinar session is more of a theoretical aspect around volatility, and at the end, illustrating again one of the indicators which help us at first, and for those that have seen the webinar on Friday, which help us to identify the direction of the trend and in general the volatility in a given currency pair. So the topics that we're going to discuss is economic data. How does economic data influence the markets? The various time zones, the 8 major currencies, the most liquid FX pairs, the most actively traded pair, euro dollar in forex trading, some economic indicators, and 3 charts which illustrate the bullish volatility, the bearish volatility, and the stochastic oscillator, which helps us to identify the direction of a trend and at the same time the volatility levels, whether the volatility will move upwards or it will go downwards. Let's see some economic data. Every day in the markets we have economic data. So economic data is a major ingredient in the forex market, even though if you trade based on events, it's highly unlikely that you will be profitable in the long run, because there are many cases that traders base their whole analysis on fundamentals, on events, and at the end of the day, the result is not the one that all traders expect, because as soon as you trade based on an event, the market has already discounted the movement. Global economic news influence price movements, and the forex market offers plenty of opportunities to trade the news. Economic news are released on a daily basis. Therefore, as most of you have noticed, the major events generate aggressive bullish and bearish volatility. So you have noticed that before any announcement and after the announcement, the markets, they start to move aggressively either upwards or downwards. Therefore, we have three types of events: the low, the medium, and the high impact events. Usually the high impact events are the ones which they generate, at the end of the day, high volatility in the markets. But as I said before, never wait for the news to arise to take your trading decision. Your trading decision should be based solely on your charts. The charts will show you, based on your analysis or based on your strategy, where the market will move next. But the news, they exist to excuse the movements. Here you can see, as you have seen most of you in the very first lecture, Introduction to Forex, the 5 major time zones in Eastern European time. Eastern European time is our time now. For example, now in Cyprus is 4 o'clock and 9 minutes. So it's the exact same time, Eastern European time. We have 5 market centers: Frankfurt, Germany; London, Great Britain; New York, United States; Sydney, Australia; and Tokyo, Japan. On the next columns of this table, you can see the opening and closing time of each of these market centers. Now let's see the 8 major currencies. The majority of traders focus on these currencies when it comes to volatility. All pairs that have high volatility are the ones which the majority of traders trade. So we have the US dollar, the euro, the sterling, Japanese yen, which the Japanese yen is a very aggressive currency, especially when combined with the euro, with the sterling, with the New Zealand dollar. So the Japanese yen, due to the latest instability which takes place in Asia, it creates a lot of up and down aggressive movements. So we have the Swiss franc, the Australian dollar, the Canadian dollar, and as we said previously, the New Zealand dollar. These are the 8 major currencies which the majority speculates to benefit from the forex market. Let's move on to our next slide. What are the most liquid forex pairs? Obviously the euro dollar, which is the by far well-known currency pair, the dollar versus the Japanese yen, the Australian dollar versus the US dollar, the sterling versus the Japanese yen, the euro versus the Swiss franc, which in the past it was considered to be, let's say, a safe haven currency pair. But this idea, which many traders had, changed after the Swiss National Bank created that crash some months ago, which most of you remember, where many brokers and many traders got negatively affected. And finally, we have the Swiss franc versus the Japanese yen. So these are the 6 most liquid forex pairs. But let's see the most actively traded pair. And the most actively traded pair is traded by the biggest percentage of traders, which they try to speculate or predict where it will move next. So the most actively traded pair is the euro-dollar. The euro-dollar represents the world's two largest economies. They represent the world's two largest economic and trading blocs. Multinational corporations, they do their business using both the euro and the US dollar. And some firms have offices in both the United States and Europe. And usually such firms trade the euro and the US dollar. So when a company is based in Europe and they want or it wants to trade or to buy goods or export goods in the United States, then the exchange rate takes place between the euro and the US dollar. So these are the two most actively traded currencies. And obviously, if we see in the next slide, why does the majority of traders like to speculate this pair? Because it's the world's most liquid currency pair. And because there is a lot of traders speculating this pair, all brokers, they offer their best bid and ask spreads. There is constant liquidity for traders because the majority of people, institutions, and everybody trades actively this currency pair. There is a high level of liquidity. So when there is high liquidity, it has high probabilities of making either money fast or losing your money fast. And the reason for this constant liquidity is because there is a large number of market participants. And as we already said, high opportunities to profit, provided that you have made the appropriate prediction. Some economic indicators which hypothetically they create high volatility in the markets. You can see some examples here like trade balance, vehicle sales, money supply, unemployment change, employment change, labor cost index, non-farm payrolls, which every time such an announcement takes place, immediately you see aggressive oscillations in the market. But as I said before, indicators are just here to excuse price movements. Never base your predictions or your strategy on economic indicators, on events. Because until you make the decision, the movement has already taken place. And you will either enter too early or too late. And the result will be confusion, closing your trades, trying to open new ones at a loss, closing your existing ones, and there is a chaos. Now, let's see a bullish volatility example on the euro-dollar. In this case, we have seen that the price from the 10th of February 2016 until the 11th of February has escalated by approximately 200 plus pips. This rise is an indication that at that moment in time, there was a bullish volatility. Bullish volatility, it means that the majority of traders, institutions, hedge funds, they were pushing the price upwards. As a result, having a bullish trend, an uptrend. On the other hand, we have an example of a bearish volatility, again on the euro-dollar, of 160 plus pips. So you have seen that from the 11th of February until the 12th of February, there was a downtrend, a bearish volatility, where the majority of traders, hedge funds, banking institutions predicted that the price of the pair will decline to lower levels. For those that have seen, again, Friday's webinar, you will see that with the right strategy that will help you to identify first the trend and thereafter your point of entry, you increase the probabilities to make the right prediction. And a way to identify volatility in the markets, or otherwise known as the trend, where the trend will go, is through the H1 time frame using the stochastic oscillator. So this stochastic oscillator on the H1 time frame is half part of the strategy which we have shown on Friday's webinar, where through the stochastic oscillator, when you see the main and the signal line connected below the 20 level, it is not an indication that the trend will change to the upside. And when reading indicators, you should try to read the indicators in terms of volatility and not in terms of overbought or oversold levels. Because if it was like that, everybody will be able to predict the markets without any problem. And the challenge of prediction will not exist. So when it comes to identifying the so-called trend, you should use stochastic to identify volatility, to identify where the current trend is. So in this case, as we have already seen in Friday's webinar session, both the main and the signal line of the stochastic oscillator crossed below 20, which this is an indication that the volatility to the downside is getting more and more tensed. So aggressive downside movements are expected to take place. And actually, this is what happened. The euro dollar dropped aggressively to the downside. So this was, in general terms, today's webinar session. It was a simple theoretical example on how to identify volatility and why volatility is so important. So as a trader, you should be able to identify that. Never use fundamentals to predict where the price will move next. Or if you're going to use fundamentals, just use it before the event takes place, but through your strategy. Don't try to trade volatility based on what the announcements will tell you. If you wait for the announcement to take place, then already half of the battle is gone. So I don't know if you have any questions regarding today's webinar session. It was a brief webinar so that you could identify the importance of volatility. Let's see one question here. My stochastic has different periods from the platform. What do you mean exactly? I didn't understand your question here. You mean you have different settings from the one which I have illustrated? From the one which I have shown? Different default settings, yes. Well, based on my experience all these years, I have identified that you should use short-term settings on longer time frame periods. Was this clear? So we should use smaller settings, smaller value settings, when we are trading on larger frame periods. So if we for example, trade on the H1 to find the volatility, the trend, let's say, we use settings like 5, 5, 10. But there is no standardized or standardized values that you should have for your indicator. To apply an indicator the right way, or a tool, let's say, because I don't like to say the word indicators, you should use something in combination with that. So in this case, we have the H1 time frame for us to identify volatility levels, but at the same time an M30 time frame, the one we have shown on Friday. So the H1 helps you to identify the volatility of an upcoming or of the current trend, and the M30 to identify your entry point. So if you can go back to Friday's webinar, or if you don't have the recorded webinar session, you can receive an email with the recorded webinar, so you can see how we combine the trend identification based on the H1, which we have seen now, and the point of entry based on the M30. Is there something that is not clear? Vasilis has watched also Friday's webinar session, and he knows how the euro dollar was, how we received the signal, and where the price of the euro dollar went even in today's trading session. Also, I wanted to ask you about how to use a Fibonacci tool, because the entry and exits for Fibonacci. The Fibonacci tool should be used based on the 61.8%. That level should be your entry point. Yes, so that level is your entry point. But if you remember the zigzag lines, in order to enter, to place actually a sell order, we want the zigzag line to form an upwards line, an up line. And once the price stabilizes gradually to the downside, we place our entry on 61.8%. And then we exit based on the center of gravity levels. Through that, we place our take profit targets. Your stop loss could be 50 to 60 pips, because if the prediction went wrong by 50 to 60 pips, it means we exit and we wait for the next settings. Was it clear, or something which I did not explain to you the way you want it? The Fib tool has to be set to correctly place the 0 and 100 higher to lower switch. Yes, I'm talking about how to plot the Fib tool. This specific tool, it's an automated Fibo tool. It changes by itself. So the indicators which, the tools which I was showing on Friday's webinar, there are tools which, as soon as you place them on the charts, they show you the patterns by themselves. You don't have to plot anything on the chart. Was this understood? So the tools, you just place them on the chart and you just read the patterns. And one example of a pattern was the sell signal, which we have illustrated on Friday's webinar session. The opposite will take place when you are to trigger a buy signal. Was it clear? No, I have to choose a swing from peak to peak. Well, it depends. This was a strategy which I'm using, but Nobody says that your strategy, maybe your strategy is fitted to your needs, to your way of understanding or interpreting the markets. As long as this strategy brings you more profitable results than losing results, then there is nothing to worry about. Which swing did you choose? Have the settings on the platform. I don't remember them exactly now at this moment, but you can send an email to support and they will forward me the email and I can answer you this question. Or you can go back to Friday's webinar and everything is there. And try to keep things simple, yes? So whoever wants or has any questions, yes, sure. The email is the one you can see here on this last slide, support@argusfx.com. So any questions, you can list them down and no worries, we can guide you and answer any question that you might have. So that was it. I want to thank you for participating in today's webinar session. Even though it was a theoretical one, it's always important to also know the theory behind any practice. Thank you very much for your time, and I'm looking forward to see you all on Wednesday's webinar, an important topic which involves expert advisors. So can automated trading safeguard your balance, protect your balance? Well, this is a question that we will answer on Wednesday, the exact same time. Thank you all. Bye-bye.